Well, good morning. My name is Jonathan Page. We are from Navy Federal Credit Union. I'm joined by Jackie Lopez, who is our branch manager, and I am our financial presentation specialist. So I specialize in giving some financial education for nonprofit organizations and sharing within our communities. So I'll pass it off to Jackie to introduce herself.
Good morning, everyone. My name is Jacqueline. I go also by Jackie. I prefer Jackie. I am the branch manager for the Navy Federal branch office here in Ontario, California. So fortunately, it's not sunny today. It's actually raining. So I'm super excited to be here with everyone. I've been in the financial industry for about 21 years and recently serving as the branch manager for Navy Federal within the last 5 months. Super excited to be here and to share the wealth of knowledge that we have for you today.
Amazing. So what we're going to be doing today is we're going to be sharing some education, financial health foundations. So we're going to be going through a lot of different topics today. So if you have any questions and things, go ahead and post them in chat. We will have a Q&A session at the end. That way we can answer any pressing question that you may have that will help you out in the future. So let's go ahead and get started. So as an overview, what we're going to be talking about is we're going to be talking about budgeting, we're going to be talking about saving, we're going to be talking about building credit, managing debt, as well as protecting yourself from fraud. So in terms of creating a budget, we want to think about are things like fixed versus variable expenses. So what those are can include things like housing, utilities, vehicle payments, insurance. I know we all pay insurance, right? And things that are variable can include things, but not completely limited to food, clothing, entertainment, and vehicle maintenance. Now, those are costs that could vary from dollar amounts or frequency depending on the month. And then fixed is everything you know that's going to hit every month, like rent, that is going to be the same every single month, so you know that that's automatically coming out. Then what we want to talk about are needs versus wants. What are those? Now, needs can include housing, because that's important, right? Next could be transportation, because we all need to, get from point A to point B. So transportation is very, very necessary. A need could be food. I mean, I don't know about you guys, but I definitely have to eat every single day, multiple times a day, so that's very, very important. And then things like insurance, and that can be vehicle insurance, that could be car insurance. If you're an entertainer, that could be event insurance. So those are things that are going to be very important that are needs. Now, wants can include things like entertainment, and entertainment could be dining out perhaps, maybe going to a concert, maybe traveling and going on a road trip. And then you want to think about things like subscriptions. I'm sure everyone has a Netflix, they have a Hulu, they have a Prime account or something like that. Those are extra things that we add for our enjoyment purposes. And then we talk about things like vacations. We mentioned road trips. Maybe it's a family vacation. Maybe it's people flying in for a wedding or something like that, right? Some sort of special occasion. So identifying needs versus wants is important when it comes to the budgeting process. Now, on Navy Federal's website, as well as their mobile app, we have a section called Making Sense. And within that section, you're going to find things like what we're looking at today, which is our monthly budget worksheet. Now, that monthly budget worksheet will help put those things that we talked about previously, fixed versus variable, needs versus wants, and it allows you to put it in an area that is very visual for you. I don't know about you, but I am a very visual learner, so I like to write things down and kind of see it right in front of me. I think that's why I became a piano player, because everything is right under my hands there. So if you look at the chart that we see here, it's going to give you to the far left, you'll see expenses and income, and then categories within it. So you'll see savings, personal, auto, home. You can name those things however you like to put things within it that make sense for you. Then on the top, you'll see where it says month, and it says income 1, income 2. So if you're a multi-income household, you can put that income there. And then it starts breaking it down a little bit further. So you'll see that next section says budgeted amount. So this is what you tell yourself, this is what I have budgeted for these specific categories, these specific things within those categories. Now, next to that is the actual amount. So you get to put what it actually costs, right? Because you won't know what it actually costs until it happens. So now you put that in that category. So now you see what you budgeted, what you actually spent, and then next is the difference. Did you pay less or did you pay more? And so once you pay less or more, then you can add some notes, which is the next section over. And within that notes section, you can start monitoring month over month what those differences are. If you're able to save anything, if you're not spending as much, if you allotted 500, but now you're only spending 150, you can put that in those notes. That way, it allows you to start heading into a direction of saving. And speaking of saving, this is where you kind of get into the financial wellness and growth section. So now we've identified needs versus wants, fixed versus variable expenses. We've identified using our budget worksheet exactly what we're saving or not saving, and where we can kind of peel the onion back a little bit and see where we can then put money away or reorganize our finances so that we're not spending as much and we're able to hit this next goal, which is savings. So now in the savings category, it kind of breaks it down into 4 distinct boxes. One box is the emergency fund. Next, we look at debt reduction. Then we look at goal-oriented savings. And then what we all strive to achieve at the very end is retirement. What does that nest egg look like for us? What does that end goal, that end picture look like based on our entire career and what we've worked up to up till that point? So let's break down emergency fund. So with emergency fund, what you want to do is you want to set a short-term goal, such as maybe $500 to $1,000, and you want to start growing that. Now, what you want to work towards is having 3 to 6 months of living expenses available for you to save for, right? That could be major home or car repairs, family emergency, natural disaster, maybe even a medical emergency. You want to make sure that you're prepared for those. That way, if anything happens in that regard, you're not going, oh man, what can I do to survive? Or having to go out and take a payday loan or having to borrow money that you don't necessarily need at that moment. Having that 3 to 6 month cushion will help you out tremendously. Next is debt reduction. So based on that budget worksheet, what can we do in terms of saving for debt reduction? So tips for reducing debt can include making larger monthly payments if we can. Use a pay raise or a bonus to reduce any debt that you have. Now, after debt is paid off, consider maybe putting newly available funds into a savings. Putting some of that extra funds away. I know, like, when we get extra money, our first thing is like, oh, what can I like spend that on, right? So now we have to train our mindset to think, okay, there's things that we need to treat ourselves because we work really hard, and we want to make sure that we, kind of reward ourselves for that work, but also consider, like, maybe we can put half of that away. That way, if we want to plan a trip for the following year, or if there's something that's a bigger goal, like, home ownership or having a down payment for a car or something like that, now you've started the process of doing that ahead of time. So by the time you get there, you're ready to go. The next is goal-oriented savings, which kind of ties into what we were just talking about, right? So what does that mean? That means saving for a specific short-term or long-term goal. Now, as the pictures kind of present here, you'll see home ownership is one of them. Vehicle ownership is another. I just bought a car not that long ago, and it was because of processes like these and questions that I asked with my colleagues and with Navy Federal that helped me put me in the right mindset to be able to afford the car that I ended up purchasing and be able to save and do the things that I wanted to do. Now, the next one looks like a graduation, right? Saving up maybe for a graduation present for your child, which is a huge accomplishment, a huge milestone. And then next is where we all like to be at some point or another, is right there on the beach, maybe sipping a Mai Tai or two or something like that, right? And a vacation. Now, before we get into saving strategies, do we have any questions about maybe perhaps any of the budget worksheets or anything about our fixed versus variable expenses or any other buckets that these savings goals might fall into? Feel free to put that in the chat if you're following along with us. or we can parking lot that question and we can revisit it at the end. All right, I see some things coming in, so we'll go ahead and keep this going here. So for saving strategies, what we want to do is a couple things. We want to create a separate account for specific goals. That may be a vacation savings, maybe it's an emergency savings, maybe it is a vehicle savings. So you want to specify those accounts so you know where your money is going and what you're saving for. Pay yourself first. What does that mean? Seems a little bit selfish, right? When you see it at first value. But that's not what we're talking about. What we're talking about is making sure that you're able to take any funds that you have and put it towards that savings goal for you. Put it towards that emergency fund for you, right? If that's $25 a month, if that's $50 a month, whatever is comfortable for you, make sure that you're able to pay yourself first. We want to make things automatic because every time you add something to your schedule, right? More than likely, if it's something that causes you to do an extra step, you may do it for a few weeks maybe, right? And then it may become a chore and you're more apt to not do it more consistently in the future. But if you can automate it, right, doing an automatic transfer from your checking to your savings or from your existing savings to your more specified goal savings, that'll make it much easier because it's kind of out of sight, out of mind. And then you want to look for opportunities to save. And that includes where you get a pay raise, like we talked about before. Maybe you paid off a loan, and now the money that you are allocating towards that loan or towards that credit card, you can now allocate towards your savings instead because that particular debt is paid off. And then any unexpected income, that could be from your pay raises, that could be from a bonus, that could be from a check that you received from your grandma because she loves you that much, right? So any unexpected income that you receive, you want to go ahead and put that away if you can. And now the last box is retirement savings. Now, in that retirement savings, you're going to hear a lot about things like compound interest. So basically what we're getting at when it comes to retirement accounts is that you want to go ahead and start putting money away as soon as you can into something that yields higher dividends. That could be a CD. That could include things like a 401k plan if you have that with your employer. That could be a thrift savings plan if you're currently in the military. That could be any sort of higher interest yielding account like a money market savings that most financial institutions will have. Those are most common. And so those kind of accounts will have compound interest, which simply means interest that kind of builds upon itself. So for example, if you had an account that started with $100 and you had a certain interest rate that is allocated for that particular account, now at the end of the month, you're going to get something called a dividend, which is a credit that is awarded to you for housing that money inside of that account. So now what your balance is, instead of it being $100, maybe it's now $105. So now when you get into the following month, you're earning interest off of $105 as opposed to your original $100. So on and so forth. So over time, you build wealth through keeping that inside of that specific account. And then we have online and mobile banking. Why this is important is because it helps automate the processes for you. It helps keep it within the palm of your hand, because that way, when you keep it in the palm of your hand, you can always monitor, right? You can pay your bills through that mobile app. You can also deposit checks there, which then makes life easier as opposed to having to always go inside of a branch. You can transfer funds from there. So if you get any extra funds, or if you get a credit or a refund, maybe you took some pants back, maybe you took a jacket back, right? And you got a refund for that. Now you can take those extra funds, then you can transfer those out into some of your more specific goal-oriented savings accounts. And then from there, once you start getting an access of funds, now you can really take control of your assets. And now you can open up accounts that really gear towards whatever those goals are for your future. If that is, the retirement piece, you can open up those. If it is the money market savings, because you're looking maybe to save money for the future, maybe those goals, the vacation, the home ownership, the down payments for things, right? And so now what that bleeds into is credit. Now let's take a deep breath for a second, because I know we've just given you a lot of information. Before we deep dive into credit, remember that credit it's kind of how the world functions right now. Everything functions off of credit. For example, if you want a house, credit. If you want to get an apartment, credit. If you want to get a cell phone, credit, because that dictates how much of a down payment you have to put down. Things like if you want to, again, go get a vehicle, that requires credit. So now we want to kind of break down what a credit score is. So what a credit score is, it comprises of a number. Now that number is derived from a lot of information that is reported on your behalf based on how you manage your current debt. Now there is a range for score, and it ranges from 300 to 850. 300 being in the red, 850 being in the green. So ideally you'd like to be in the green. Now, these are all opportunities for growth. So even if your credit score is lower at the moment, there are tips and tools and things you can do to help build your credit. And so one of those is understanding what factors dictate the number that you receive from your credit score. Now you can look at your credit score from things like FICO, or Vantage is another company that will monitor that information and give you a credit score. Navy Federal's mobile application uses Vantage 3.0 as their monitoring program. So the score you get is very similar to what you'll see in things like Credit Sesame or Credit Karma, which are a couple free apps that you can monitor. And even through Experian, they have an app where you have a free membership there as well, in which you can then monitor your score. Now the factors that will give you the number within that score are as follows. So we have account owed, that's the amount of debt that you have. That's huge, that's 30%. Then we have new credit, that's 10%. Any new credit that you apply for will show up there, and that affects your score about 10%. So not a huge amount, but it is important, right? So if you have a bunch of new credit that you haven't used, the idea is you want to manage debt, not just accumulate it. And then if we go down the wheel there, you'll see length of credit history. This is big, right? Because they want to make sure that you can manage your debt over time. That's how you get your credit history number. That averages out to about 15% of your total score. Then down is credit mix. So what they mean by credit mix is going to be things like credit cards is part of it. Installment loans, which is any sort of loan out there, which is going to be personal loan, debt consolidation loan, mortgage. So any of those mix of those items is great reflection on your credit. And then the big one that I always stress to everyone that we have these presentations for is going to be payment history. So how accurate are you with your payments, right? So just to give you an idea of how important payment history is, if you miss one payment, it takes 12 payments to kind of wipe that one out. So one payment takes you a year, right? So that's why it's very important, because to a lender, when they take a snapshot and they run your credit for anything, they're going to look and see these things. What is the payment history? How do we know that once we give these funds, that you as the client will be able to pay that back on time and be reliable with those funds? Now, tips for building credit. So if your credit is not where you want it to be, where there's opportunity for growth, here's a couple ways that you can build your credit. You can pay all bills on time. I guess it's pretty self-explanatory, right? Pay everything on time and you're good to go. You can use credit responsibly over time, and you can keep credit card balances below their limit. So ideally, on your credit, you'd like to keep your credit card utilization below 30%. The most ideal is 10% or less, because you'll know anything above 30% can get out of hand really quickly. So you want to make sure that if you look at your credit report, that you can pull from things like myannualcreditreport.com, or you can even go to irs.gov and you can pull one free every year. That'll show you exactly where your credit report is looking right now, where your balances are, and where you need to improve, or the progress that you're making, more importantly. Now, in terms of credit card payoff, the reason why we want to keep it below that 30%, as you view on the charts here, right, is when you have higher balances and you're making minimum payments, you'll see that, like, in that first graph there, you'll see that most of the payment that you're making is going to interest and not a lot to principal, almost 50-50, right? And then next one over, you can make a slightly larger payment, right? The majority of it is now going to principal, a little bit is going to interest. And then once you pay it in full, everything is going to that principal and your overall balance lowers at that point. It's hard sometimes when you make minimum payments. Yes, it keeps it in good standing that you didn't miss a payment, but then we're talking about compound interest with credit cards as well. So you're kind of fighting some of the interest charges every month. So you may not see the kind of traction that you think your money should be doing. So the larger the amount that you can make, the better. Now, before we get into types of debt that Jackie is going to be kind of diving into further, again, what we talked about before to kind of reiterate a lot of the tips and tools. One, it's identifying needs and wants. It's identifying what your fixed payments are versus your variable payments. Identifying and writing those things down on a budget worksheet. We're looking at what our savings goals are once we get to identifying what those savings or opportunities for savings are based on that budget worksheet. And then from there, we're going to decide where can we allocate that money. Is it going to be to an emergency fund? Is it going to be towards retirement? Is it going to be towards debt reduction? Or is it going to be towards some goal-oriented events that you have coming up in the short term and the long term? And then from there, identifying what things is going to be needing more attention to your credit, understanding what's within your credit score, understanding what is in your credit report, and then being able to affect those things based on some of the tips and tools we talked about, which is making sure that your credit card is in balance, right? And keeping it in a modest balance, something that you can keep control over, making sure you're making your payments on time, making sure that you monitor your account via any mobile app that you currently use, and making sure that we can automate those things to make your life easier. All right, Jackie.
All right, thank you, Jonathan, for all that insightful information. So the next part is more of my expertise as a branch manager. I love to go over managing debt and being able to help our members reduce that cost. So a couple of things that we can want to go over, like what is considered good debt versus bad debt. So good debt is more of those financial journey goals that you have, like buying a home, living in an apartment, or bills that are coming to kind of fulfill your needs versus your wants. Bad debt, honestly, there really isn't bad debt. It's just kind of like getting yourself a little bit into trouble with the extra spending, kind of looking at the extras, the wants versus the needs. Next slide, please, Jonathan. So managing debt is very essential to our financial journey, especially to try to help us get out of that debt. Couple of 3 takeaways I like to keep in mind when I'm talking to the member is really learn to borrow what you need. If you need to make an emergency purchase like tires or something like that, you only need what the cost of that is. Also, know how much you owe. Being able to assess that information via statement or online banking, it's a great tool to have you budget as you go. And looking back at that resource that Jonathan shared with us of doing the fundamentals where your income is going and allowing yourself to, do you have extra within your budget to pay this off? Send a little bit of extra money towards that. An emergency fund is being in place, allows any person really to kind of offset that unexpected expense. For instance, if you have car issuing or if you have medical emergency, having that emergency fund will alleviate more making that purchase versus using a credit card or reaching out for a lender for loans. Next slide, please. So one of the key things I like to share with all of my members is really try to avoid delinquency. As Jonathan shared, that one late payment can take a few months before it can be dropped or overlooked. In the event that you're looking to do a loan, any recent delinquencies may hinder the outcome of that application. So we always want to be careful with that. A couple of tips I may share with you today is paying your bills on the due date. Having that automation, even if it pays the automatic minimum payment, that's going to really help a long way. simply because then you know your payments is on time. It's going to go ahead and reduce additional fees that are unnecessary, but at the same time, give you that structure. Having that structure of your payments coming out on a certain day would allow for those payments to take, that delinquency chance away, and it also kind of alleviates that pressure if you are, let's say, on vacation away, or you're not able to get reception to make those payments. At least they're automatic. Minimums is something that is really up to you if you want to set a set standard, but at least paying the minimum will avoid any delinquency. Also, my favorite pro tip is always use online banking. If it's more conceivable not to do it automatic, but to jump onto the platform and make the payment, that's always a great tool set too if you want to be in charge of those payments. And of course, always pay as much as you can. Don't always go towards the minimum, but try to overreach yourself when possible, as long as your budget allows that. Next slide, please. So tackling your debt, kind of the best practice I have for our members and any consumer about that is that if you want to make an impact about how to relieve yourself from debt, couple of things that I see is like the snowball effect. So if you're paying small balances like your minimums, you're impacting that debt very slowly. So it's like throwing it as you can. But if you want to really make that impact to reduce your debt, paying the highest interest rate first is going to really help, because then less of your payment is going to go into that interest. So paying those top interest card is always the best. And then kind of giving that effect where the debt starts going downward. Next slide, please. So options for managing debt. One thing I always walk away with, or to tell our members, is if there is a situation that's hindering you from making payments, please never hesitate to reach out to the lender and share your story. Calling your creditors, have them understand what your situation will be, because you'll be surprised that nowadays we have programs that may help. For instance, we had a government shutdown and some of our members were impacted. So what we do as a lender, when our members reach out, share with us their story, we try to see how we can alleviate their situation. It's on a case-by-case basis. However, any creditor, lender, debt consolidator, they will look at the holistic financial journey and see what you can do. But another option for managing your debt is also if you find opportunities where you can transfer the debt to another lender that might charge you less interest. You won't find that many zero balance credit cards, but you might have lenders that have lower rates, or even use collateral loans to kind of help you reduce that. Next slide, please. One of the things we kind of take away from lending is try to avoid predatory lending, meaning those fast, quick turnaround loans, because those can get you into trouble, especially if we don't read the terms and conditions in the fine print. Next slide, please. So protecting you from fraud. This is one of the most impactful topics I like to reach out to the members and talk about. Specifically because fraud is always in the high. We're going into the holiday season, so we just want everybody to use caution. We have great resources on our website that gives you the opportunity to learn what kind of scams out there, but I'll briefly share with you what fraud may look like. Next slide. So one of the things we tell our members to use caution is phishing schemes. If it sounds too good to be true, it's not true. So make sure you don't fall between those situations where you think you're going to give you a bonus check just because if you fill this out. Predators out there are just trying to get access to your information. The more they acquire, they're able to take away and even lock you out of your system. Next slide. One of the things we're seeing a really high influx in the financial industry is phone scams. Phone scams are always fraudsters that are trying to pretend they're a financial institutional entity. If your bank is calling, trust me, you could hang up and call them back and actually save yourself from being scammed over the phone. With AI and technology, a lot of these items are harder to spot. So one of the best practices I take away is if they really want to get in contact, like if the real financial institution wants to get in contact with you, they will always allow you to hang up, call them directly, and then kind of go through their verification. They will never ask for codes. They would never ask for you to share more information than you have to, because the financial institution already has certain things in place. For added protected, I would always try to see if you can add a code word, or if they do voice recognition, try to sign up for that. That would alleviate some of these phone scams that we're seeing in the financial institution. Next slide, please. So identity theft is one of those really big topics in fraud, so we just want you to be careful when it comes to sharing your information and safeguarding your documents. We always recommend using strong passwords and monitor your accounts, and at least review your credit report at least once a week. Next slide, please. I mean, not once a year, I apologize. Next slide. Always never provide information. So if you're speaking to a financial institution, like I said, they have the information. They normally just want a verified contact. So that kind of helps out a little bit. If they're asking like Social Security, driver's license number, more details, go ahead and hang up and just call them directly when you have those suspicions or gut feelings that this may not be an authentic call. Next slide. Card security, always be mindful of your surroundings, especially nowadays we have readers that can read your debit card, your credit card. I always recommend look at your surroundings before you put in your card in a slot holder. Double check that it's not compromised. You are always welcome as a consumer to look at the machines, and if that looks like, you know, that it's been tampered with, do not insert your card. Just go ahead and report that to your institution so that way they can be aware of that. Next slide, please. Fraud response. So one of the things I always like to share is fraud can happen quickly. They can deplete your account, they can start stealing your identity, but the recovery of that is really hard. So we always recommend to our members to always use caution. Always be able to monitor what you can do with your credit report, what's happening. If you know that you didn't apply for a car loan, go ahead and call that lender right away. Also, as a consumer, you have the right to add fraud alerts. So if something does happen to you, you can put restrictions where if credit needs to be run, they need to call a specific phone number, or you need to provide that code that allows you that lender to review it. And always remember, financial theft is a big situation, so filing police reports will always also defend you when it comes to those situations for fraud. Next slide. So what all this encompasses is that our journey to your financial journey is we want you to go from attaining your first job, hitting your financial goals. So in the end, we want to look at a happy retirement. But as we retire, we also want to be able to take measures, safety measures, to make sure that what we work for doesn't get taken away quickly. So this is kind of like the journey map that all trusted advisors use to kind of help you, guide you to those endeavors, and hopefully achieving it within your timeline. Next slide, please. And then I just want to reiterate, we do have some financial education hubs about making sense that kind of goes over what Jonathan and I went over. Great articles, great flashcards to kind of review what that may look like. The articles really elaborate more on each topic, so if you want to research a little bit more, you're able to do so. Also, there's a QR code for your reference, but hopefully you take advantage of these tools. If you have another financial institution, they might have also theirs. So the more information, the more resources is always a great way to protect ourselves. Next slide, please. So I just want to end our presentation with just a reiteration. The mission is our members. It's you. Anytime that you have any questions, we are here as your financial institution, and we were happy to kind of review more information and giving you this opportunity to do a question and answer.
Hi, Jackie. And thank you so much, Jackie and Jonathan, for a really great presentation. I learned so much from this presentation myself about financial wellness and fraud. There is a question that we had received from some of the people here was typically veterans face gaps in credit history due to deployments, overseas service, things like that. And what are the most effective ways to rebuild or establish credit quickly without falling into the high-risk trap?
So I'll go ahead and take that. So one thing that you can do, especially if there's gaps in employment or if you're kind of have been deployed abroad, we have secured products. We have our secured credit card, which allows you to, once you maybe transition from military life back to civilian life, or that you have some time to kind of monitor to help you kind of rebuild credit that way. It allows you to do so in a safe and reliable manner without having a lot of risk to your already existing credit score. We have it on the loan side as well, which is our secured pledge loan. So you have a secured product that's based off of your own funds on the loan side, and one that's based on the credit card side as well. Those are two really great tools. Also having, those that can monitor your credit while you're abroad as well. So even if you are abroad, having a spouse on maybe a card or perhaps having a joint owner like a parent kind of monitor those things while you're away are a couple great ways that you can then help keep your credit intact while you are doing important work overseas and abroad.
Thank you. That is definitely helpful and good to hear about some of these products that you guys have. Another question that we had was, so many financial freedom plans assume stable income. And we realized that with the world changing towards gig and people having disability benefits or inconsistent employment, how do you advise the veterans navigating these issues?
Can I have you repeat the question?
Yes.
I know it was a little bit long.
Yes. So a lot of people are right now in inconsistent employment, whether it's gig work or disability benefits and things like that. And a lot of the financial freedom plans assume stable income. So what are the kind of things that are, if people don't have stable income, like what are the kind of plans that they can have?
To be very transparent with you, couple of things. Each financial institution has their guidelines. So we can't really reiterate what that may look like for other institutions. But for us, we always kind of recommend coming in with that information, sharing your whole financial story, and see what is it that we can do to help. Unfortunately, it's not a black and white answer for me to be like, these are the proper steps. There's a lot of consideration nowadays. Post-COVID has allowed the industry to kind of review the holistic photo of everything and kind of make more like suggestive guidelines of how to approach certain things. We do have things that can be seen as protected funds, protected income, but we would really have to look at that financial picture on a case-by-case basis in order for us to really respond to that. It is a little bit outside of my scope to really provide a more clearer answer, and I do apologize about that, but I just do want to be transparent that, each institution might have different guidelines and kind of reaching out to them, and this is where that open communication with the lender would come into play for them.
That definitely makes sense. So Jackie, last question before you guys wind up. This is top of mind for me. Just curious, as a branch manager, what is the most common concern or question that you see people come up with that maybe if people had known better, they wouldn't have gotten into that trap or issue, just to address for the audience broadly?
Yes, thank you for that question. So kind of the thing that we see more nowadays is having that financial education, really understanding what that financial journey map looks like. So a lot of our members will really give us feedback about, I wish I would have known this back in high school, that the first step to really monitoring your financial wellness is to set up a budget. Set up automation that would allow this to happen no matter what. And like Jonathan had shared, when we have instances where we have additional income or that grandma's check for Christmas, really saving it and putting it away for emergency funds. Having those fundamentals set at an early stage in life allows us to really hone into our financial skills to build on that. And then, of course, using your trusted advisor, your institution, your banking institution to really guide you. Of course, you don't always have to go with the first opinion, first option. I always like looking at seconds, just like a medical professional, kind of get that second opinion and kind of really reevaluating each journey step that you take. The more you do that, that really allows you to build that financial strength, those really great habits as we go into different economical times or even our career, to build on those things. So a lot of it is just really honing down the fundamentals, being able to create those habits early on, but it's never too late. So if you find yourself in the need, setting a plan really helps, and setting those specific short-term, long-term goals and working with an individual that's going to guide you with that. And that could be a trusted advisor. It could be even a CPA or a financial advisor. It's really up to you what you would like, and kind of set that roadmap. Once that roadmap is set, it's more attainable, more achievable. Having that eyes on it, like using your online banking, your statements, looking at it, and kind of like reassessing all the time. And of course, we understand emergencies will happen. So having that set up, but if you don't, that's okay. You know, we're not perfect to get all those fundamentals in right away. But reach out to your banking institution, your trusted advisor, and kind of really like look at options, weigh them, and say, does this really make sense for me? Is this a want or a need? And then kind of move forward in that direction. So it's okay. Like I said, it's never too late. You know, I myself use a budget till this day. It just allows me to really assess and adjust. And then if I have extra, then I will be paying off the higher interest and moving forward that way to have that security down the road.